Welcome to afternoon 2 of TechBBQ. Super happy to be here. My name is Joe Perkins, and today we'll be chatting with 3 VCs about essentially how to operate in a downturn, how to be resilient as a founder, how things have changed versus the frothy times of 2 years ago. I've got a number of questions to go through. Slido is going to be open, so if you have any questions, just fire them in, and we'll try and work through them. But before we get started, can we get a quick intro from you 3? Little bit of background, minute each, starting with Monik, fire away.
So I'm Monik, Pham, one of the general partners at Pact VC. We invest at pre-seed, seed across the UK, Europe, across 3 themes around fintech, healthcare, and sustainability.
Hi everyone, my name is Triin, Linamagi. I'm the founding partner of C Ventures. We back gender-diverse founding teams in the UK and Europe, pre-seed and seed primarily. That means that at least 1 female founder needs to be in the founding team, but we're all about diversity.
And I'm Eric Lachey. I'm the founding partner at byFounders. We are a 4-founders byFounders fund backing next generation of founders in the new Nordic. We are focused on early stage founders where we can make the biggest impact. What sets us apart is that we have a collective of some of the most accomplished founders and operators from across the new Nordic that is helping. So not only capital, but a lot of operational guidance to see these journeys. And what we are going to discuss today, I think, is very relevant for this.
Cool. All right. We're all friends. So let's get going. And I want to take a couple of steps back first and just ask, everybody's talking about the downturn, how markets have changed. For founders that are starting up now, started in the last year or so, I wanted to kind of throw it to all of you and ask, what the hell is a downturn? What are the characteristics of the market that we're in now? Perhaps, again, Monik, starting with you.
Yep. So I think from our perspective, let's say earlier stage, kind of the downturn perceived from the earlier stage is generally, slower funding, I guess. Yes, there's a lot of kind of dry powder out there, but investors are kind of, being more selective or deploying their money a lot slower. And, we've also seen a lot of companies fail quicker right now as well. So I guess that's part of the downturn.
I think from our perspective, what we always say is the fundamentals of raising capital have completely changed for pre-seed, seed stage businesses as well as later stage businesses. So what we said to the founders 2-3 years ago don't apply anymore today. And another area that we focus a lot on is manage your expectations around customer appetite and the budgets. So this is another area that is taking a big hit right now.
I would say, first and foremost, I think there's just increased uncertainty in the market. The funding is the after effect, but the fact is that we are just seeing all the things that we were easily walking into, acquiring customers, retaining customers, and it's just really fundamentally changing right now. And as a side effect, then being able to raise on the metrics that you did before is really just tipping over.
Yeah. Okay. And Triin, you mentioned, obviously, you work with a lot of very early stage companies. You mentioned the advice that you're giving them now has shifted versus 2 years ago. Can you talk a little more about that? What does that mean in practice?
Sure. I think 2 years ago, it was a lot about FOMO, right? We all agree. It was very much about FOMO and how to present yourself in the best possible way. It was investors market. Today, it was founders market. Today we have investors market. It's very shifted. And pre-seed, seed stage rounds were about 2 million, maybe about 2 years ago. It made sense to go and raise venture capital money with a deck only, no product, perhaps a very minimal viable product. Today, I think what we're seeing a lot and what we advise our founders to do, go out, validate, don't raise venture capital money too early. Try to maybe raise some angel money, do a lot of validation, build up your metrics, get better valuation, and then go out to raise that larger venture capital round.
So, just gaining significant more traction before you actually go out to market.
And validation is the key. We all want to see more validation on the market right now.
Okay. And Monik, you mentioned kind of the dry powder, this mythical dry powder that everybody always talks about, is still there, but investors are deploying slower. Why is that? Like, is there a lower quality of startups? Is there fear in the market? Like, what is the main reason?
Yeah, I think it's all tied to all the earlier points mentioned. Given customer sentiment, customer appetite is changing. Companies, so the customers are being more. For example, we do a lot of B2B. If you're a B2B SaaS tool or product, the spending on like SaaS tools and products is decreasing. So I think it's all kind of essentially tied together. But you know, so around kind of your main question of, remind me again.
Investors slowing down.
Investors slowing down, dry powder, sorry. So I think all these factors, decreasing kind of slowing down the traction companies are getting, they're being a bit more selective. Mm-hmm. The dry powder is there because there was a lot of money raised in the last 3 years, and that money isn't all spent. Yeah, there was a lot of kind of crazy spending 2020 to 22. So there is dry powder. Investors are being more selective because of the performance of the companies. And for example, 2 years ago, we would not have said, come back to us like a pre-seed company, come back to us when you have some traction. But now we're finding ourselves say that a bit more because we're a bit more hesitant, especially all the new funds that were raised in the last couple of years, like we're Fund 1. So, you know, there's a lot more kind of burden on us to essentially be a better, like a great performing fund. So we are being a bit more selective in the companies we invest. And I guess the whole point of venture capital is like taking a risk going in early. But, you know, I think unless you're a pre-seed dedicated fund, if funds do pre-seed and seed, they will tend to be a bit more risk averse and go lean towards a seed stage rounds.
2019, 2020, the concept of like too early didn't really exist, whereas now it's a bit more.
Yeah, and I know founders hate that, so very much aware of if you're a pre-seed seed investor and you say go back and come back to us when you're ready. I'm very aware of how counterintuitive that is, and I don't think this will be forever. I think this is like the after effect, the impact of the last couple of years. So this is why I think this maybe lasts for another 12 months or less. But yeah.
Fingers crossed for that. Eric, you mentioned...
I was just going to say, I honestly think that, downturn, it sounds negative. I would say we've been in a world for the 5 years where it's been just like completely, crazy.
Yeah.
And what we are coming back to is a new reality. And I think it's a super healthy reality.
Yep.
And I think those founders that are starting today will have much more resilience and be having much bigger chance of being successful, because in the past they could basically go to any fucking VC and get new money, and just like their game was much more than, hey, how do I get to the next round of money, versus staying focused on their customers and creating real product value, finding product market fit. So many founders have failed on that, and we as VCs have failed on that because we've been going out and say, hey, grow at any cost, instead of saying, build a product that people love. And now, for those who have already been in the game for the last 2-3 years, they built a product that at the end of the day, people don't love. But the VC have created a distorted reality for them that, hey, if we pour more money into sales, marketing, all this shit, we can actually get that. But the fact is, if you know, like Figma, I think is a great example. It's take years for them to get to where they found the product market fit. When they finally found it, it goes like this. The same with Wizard in our portfolio. We are seeing the founders that are patient and hold on, they can do much more successful. So in this downturn, this is where you really can make, and as VCs as well, we can find pure gold, but we need to stop talking about growth. We need to focus on product market fit.
And so do you think that it kind of leans into staying lean, like iterating fast, keeping the team size small? But I guess, Triin, do you think the wider investor market has taken those expectations on board themselves? As in, like, if it takes a company 3 years to hit product market fit now, a couple of years ago, a couple of years ago, if you hadn't raised your Series A in 3 years, it was like some sort of orange flag. Whereas like now, do you think investors in the market are going to be more patient as well as expecting the founders to be?
I think there's a bit of a herd mentality there, because right now everybody's saying in venture market that we need to slow down now on the growth. We need to focus on product market fit, profitability. Now everybody's saying that as soon as markets shift, I think as soon as the herd starts moving towards the other direction, we will all start moving towards the other direction. But I think it's very confusing for the founders, the information we are sharing.
Yeah.
You know, 2 years ago, we told them, growth, growth, growth at any cost.
Yep.
And today we're telling them, in the next 12 months, I want to see profitability. And I think we are sending out very mixed signals, and us as investors have to take responsibility on helping our founders understand what does that look like in the next 5 to 10 years to come, and stick to that. I think we are all kind of using that herd mentality right now and changing our shift and our gear. So I think it's very important to stick to what we decide now. If we want to see profitability, if we want to see that product market fit, let's stick to that then.
Okay.
But indeed, I think yes, I think funds are really. There's a lot of dry powder out there for a reason, right? We just don't see that product market fit.
Yeah.
So and the good founders are still funded. The ones that actually can demonstrate that they get the funding and they have the advantage. So it's a very good time for these founders to raise money today who perhaps have not thought about it in the last couple of years, but have bootstrapped, have used other methodologies to get there. This is their opportunity to get a very good deal.
Yep. I mean, potentially lower valuation than 2 years ago,
Absolutely.
but like growing on your own terms, right? I guess that, I mean, for me, like the elephant in the room is like, what about all those startups that were funded at crazy valuations, pre-product market fit? Like, what are you saying to those guys now? They raised on like a 20 million seed round. They still haven't got. Are these companies fucked?
Yeah, well, I would say like there's definitely in 21 especially, it was a crazy time. Tiger Global was like the picture of this, where they would just write in and write crazy checks. And definitely valuations are out of scope. The good thing is they raised so much money that the opportunity is now pull the brake, go in, preserve cash, and actually get back to the basics. And because they have like raised a lot of money, they actually have a long runway, and they can get back to the stage where the revenue multiples and whatever we are looking at adds up in a good way. But there's going to be blood on the dance floor. It's going to be brutal, and especially in the later stage when you suddenly have built empires of 200, 300, 400 people, and that when you're looking at your burn and you're seeing that it just doesn't add up, a lot of these companies have to pull hard, and that is very, very tough.
Yeah, I mean, like the cost-cutting side of things, I mean, it's pretty savage, right? Because ultimately, like, most of burn consists of headcount. So, like, essentially, like, there's a whole bunch of layoffs happening right now. I mean, I don't know if any of you have seen this happen in portfolio companies. I would guess so. For founders out there that are kind of in this position of potentially raised, pots of capital, pre-product market fit, what advice would you have to them in terms of like making layoffs? Like it's like the shittest thing a founder kind of has to do, right? I know that's a tough one.
Yeah, we're still we focus on early stage companies, but I mean, advice for founders making layoffs. I think also if you're unsure of it, then also get help from advice from your investors as well. If you have supportive investors, and get their guidance on layoffs. But I mean, look, our company's the biggest one has about 20 employees, so they haven't had much. But on the flip side, on positive spin, we always see we see these layoffs as an opportunity for like the next couple of years of hopefully new talent entering the market. So that's one positive. But yeah, I can't say I've got loads of experience of our portfolio companies laying off tons and tons of people. So I don't know if you guys do. But yeah.
Our experience is very simple. Yeah. Rip off the Band-Aid fast and do it like aggressive. Don't think that, we can do this, and then after 6 months come back and do a little bit more. Yeah. That creates, havoc within the organization. Look at your eNPS score, it will just go like this. And I think exactly in a downturn, the number one thing as a founder and a leader, you really need to look at culture. You need to step up and give everybody that's sitting there and are like shaking of nervousness and seeing what's going on, you need to give them confidence that, we can make this through. Yep. We also need to get around this together.
Stick together and keep people happy.
As the only founder on this on the panel, what would be your advice?
Oh God.
Sorry, I just...
I'm the moderator.
Put you on the spot, but I mean...
I think, like Eric said, do it fast, be transparent, make people realize that, I made layoffs at the end of last year. It was absolutely shit. It was one of the worst things I've ever had to do. And make people understand that, this was, my fault. I was leading the company, the buck stops with me type thing, and then just help people move on, really. But yeah, it's just never going to be nice. It's just always grim.
And I guess don't burn bridges in the process, right?
Yeah,
Things come around.
Yeah, and I think you can do it. You can do it in the right way, but yeah, it's not enjoyable. Let's put it that way. I think I just want a final question, I guess, on the kind of pre-product market fit side of things, because I think that's where a lot of companies. Getting to product market fit is bloody hard, right? It can take years and years. Your point about Figma, I think it was 10 years before they ever really believed that they had product market fit. What, from your side, Triin, working with these early stage companies, are you seeing more pivots? And I guess to everybody, what's the kind of advice you give around pivoting to your portfolio?
Yeah, we're seeing a lot of pivots. We're seeing a lot of inbound applications today from B2B businesses, whilst we used to see much more D2C.
Yeah.
And it clearly means a lot of businesses have pivoted to B2B.
Yeah.
That doesn't mean it's easier. As Monik just mentioned before, B2B SaaS tools they don't have an easy ride either, right?
Yep.
It's harder and harder to sell to enterprises and corporates right now. So I think it's very important that if you do that pivot, you truly understand that before you do that pivot, you have validated with these enterprises that B2B is a route to take, or SMEs, or whatever B2B approach you're taking, before you make that decision. Because that will change your fundraising path slightly as well.
Yep.
We'll have to go to market, to investors with a completely new proposition, technically, with a new business model, that you have to show that you validated.
Yeah.
If you don't have that, it's very difficult to raise at a better valuation because you have pursued a D2C path. And that's where I've seen what is the biggest pitfall for a lot of founders who are doing pivots from D2C to B2B.
It's like unvalidated pivots.
Absolutely. Unvalidated pivots.
Just to add to that as well, just because you and I have had discussions about pivots before, I think there's a couple of things. Going into the market before, as in just when you've had the idea for a pivot, is I think probably risky. You end up just kind of flailing in between. I would actually recommend if you have runway, if you have money in the bank, and you know things aren't working, and deep down it's not working, and the numbers are showing that it's not working, you're not growing your typical 10% month over month, and you're not getting good feedback, and you're not kind of selling fast enough, then I think it's always a good time to pivot when you have money in the bank, but also before you have such a big team. Doing a pivot with a massive team is also problematic because it's like, hey, you're working on this, but by the way, we've now changed our mind, we're building this thing. And that's going to be a whole morale thing, a team kind of issue. So I think be kind of honest with yourself about the pivot and know that you have some runway, some money in the bank, and that your investors are behind you when you're thinking about pivoting. And there's also a danger of getting too much advice and too much feedback. When should I pivot? Should we pivot now? Should we do this? And taking on too much outside advice. You as a leader will ultimately know the performance of your business, and if you're not complacent, you respect and value your investors' money, and you have runway, I'd say then be a good time to pivot.
Okay.
But just to
Please.
round it up, I think I'm impressed by founders that dare to step up and say we want to do a pivot.
This isn't working.
This is not
try
working.
Something else.
Admitting or realizing that you managed to convince us and everybody else to come on this bandwagon, and 3, 4, 5, 6 months later, you're saying this doesn't work. A few years ago, we would not see it because they would just go out and raise some more money and try to, sugarcoat it. But now, and I think it's really encouraging when they come and do that. But I would also say, no surprises. So, I've been experiencing where I've come to a board meeting and they said, we decided to pivot.
No discussion.
And
made the decision.
that is a really, really bad way to start a board meeting versus saying, hey, I thought we came on board on the journey together, and then we would love to actually participate in that type of decision, and maybe we could actually help you through what we can come to a market analysis and so on, and help you navigate that pivot so we again are behind it.
Yep.
Because we've been in a situation where we simply said, the pivot you are doing, you have our money, but you don't have our commitment, no more. And it's not good to have an investor behind you that doesn't have conviction.
Yeah.
When you lose that, it's very difficult to add new investors on board afterwards.
Yeah.
So just play ball. Like, I think that's the key between the founder and the investors. We've all been there.
Okay. I mean, that raises an interesting point around what advice would you give for founders? Like, how do you share bad news, like, with your investors? Because I think a lot of founders will keep this stuff to themselves a little bit. And to your point, Eric, like, hey, we pivoted at the next board meeting. And it's like, nobody had any fucking idea that, like, the pivot had gone on. So, I mean, Triin, from your side...
Share good news first.
Good news first.
And I think, as you said, Eric, get them involved more in that decision-making. If it's about pivot, perhaps don't announce a pivot, but say, this is not working, we're thinking, we need to move to another direction. Get them involved.
Yeah.
And I think if there's a bad decision to announce, you have to announce it. Be honest, be transparent. I think most investors or experienced investors are used to take it. And I think if it's about market downturn, layoffs, you just demonstrate that you're decisive.
Yep.
And you just need to be able to argument it well enough and why you made these decisions. And I think it's great. It's great. You actually showing resilience and decisiveness in this process.
Okay.
I mean, you should have if you yourself are shocked by your company like not doing well and you have to give the bad news, I think then ultimately you haven't had your finger on the pulse. So really knowing in advance, like, you should be able to spot where things are going wrong and things that are out of your power, out of your control. Let's say you don't have a particular expertise in that area or space. Like, ask your investors, and even if they don't have it, they will know someone.
Yeah.
They'll be able to bring in someone to support you. So, like, I had one of my angel investments, my COVID angel investments. I still believe there was a huge kind of gap in the market for this. But, when they went under, they still had 12 employees.
Yeah.
And we were just like,
burned so much
why are
earlier.
you going under with 12 employees? You know, I think there's also a thing you're like, I'm loyal to my team and this is my team, I can't let them go. But 12 employees is a big kind of, big expense. If you had, maybe had done your layoffs very well, and then you would have extended your runway and maybe come up with a creative way of either pivoting or finding an alternative or bringing in expert to support you. So I think it's being experienced enough to see the red flags early.
Yep.
And bring in and support and advice if you don't have that personal experience or expertise yourself. Like, don't come in and say, we're going bust. Do you have anywhere from where my 12 employees can go? I'll just say no.
So sharing bad news early as well.
Share bad news early, because yes, it's great when we're all sitting around on the board meeting, patting each other's back, saying, aren't we amazing? We're so smart. We're going to make so much money. But I'd rather know when things go wrong rather than just always getting good news. So if I get an investor update, it's always like, this is going really well, but really I know that your banking provider or like your infrastructure provider's gone bust because of fraud. Like, we'd like to know these things. I'm not a banking expert. We'll be able to support you with the transition. So just tell us early.
Okay.
Find people who will be able to support you. Yeah, that's fun.
Okay, I want to shift tact a little bit now. I think we focused on a lot of negatives. Now, if we are working on the assumption that Eric is working on, like, this is the new normal. We're not in necessarily a downturn, but the past 5 years was just so frothy, it was mental. If there are founders in the audience that are going out to fundraise, Q4 next month, what does the new fundraising process look like? Like, what's changed? I mean, 2-week deals, they off the cards now? Like,
I don't know if the fundamentals really have changed.
Yeah.
I think I would always encourage the founder to really emphasize and double down on describing the problem they are solving.
Yep.
I think too often we meet founders that start presenting what they do into a solution mode, but they actually don't capture us at the problem stage. And honestly, if we don't understand the problem and we don't understand how big this problem is, everything else you say from then on doesn't matter.
yeah.
So I would just say, no matter what, that is what I always like to say, and I tend to exaggerate. Say, if you could get me to cry, I write the check immediately, because then it's
storytelling.
It's such a problem that needs to be solved. And the problem, like one of the things that I really also would say, here in the Nordics, the biggest problem we have with founders is that they simply don't think big enough.
Yep.
And I really, really encourage people to think like the problem that they are deciding to spend the next 10, 15 years to do and solve and go out and change the world with, is that really a problem that is worth solving? Or should they go back to the drawing board and find something that really makes a difference?
Okay. And so founder comes, pitches you the moon and the stars and everything. What's changed on your side in terms of, where we are now? Is diligence taking longer? I saw somebody tweet the other day that VCs are now asking for pre-seed data rooms, which a couple of years ago, a pre-seed founder didn't know what a data room was, right? Like on your side, when you find a deal and, want to pursue it, how's the process changed? Or has it?
No, our process hasn't changed. I think to Eric's point, the fundamentals still remain the same. Because our model, we essentially do bigger tickets at early stage and we do less deals every year. So we're not a kind of massive volume play kind of investor. So our DD process generally takes quite long anyway. So the 2-week term sheets has never been our thing. So I think, again, pre-seed, very little information you can go off. We do, for example, a lot of referencing now, maybe a lot more than we used to.
Okay.
Referencing on the founders and the market. So we'll do a lot of expert referencing as well, and previous employers, teammates, and so on. So that has amped up a lot. But fundamentally, what we look for hasn't really changed. It's always,
And Triin, on your side with the Catalyst program you run, are you seeing different types of startups and different types of founders, making applications to come onto cohorts? Are there maybe previously would have been bootstrap founders? Is there a higher volume of them? How has that changed?
More AI founders,
yeah.
perhaps.
Okay, yeah.
I think AI is something that goes through every deck right now. We just talked about it with Monik before. Maybe you should think that through before you put it on a deck. What we like to do is when we look at the decks and try to remove AI from it and to look at it and see if that still makes sense as a business case.
Yep.
And then put the AI back and how does that actually help? So anyway, that's AI. But other than that, I mentioned we definitely see more B2B founders. We've had an increase of a lot of healthcare businesses. I actually can't give you the reason why is that, but we've had probably 30% of healthcare businesses that we see inbound this year.
Okay.
In terms of the traction, we've actually seen a lot of much mature businesses coming to us in the Catalyst programs. Yeah. And if anyone doesn't know, Catalyst programs really support founders to raise capital and get the basic understanding of what they need to know to raise venture capital particularly. And I think these more mature businesses coming to us right now just shows they want to make sure they make the right decisions when they go out to the venture market, and they have more awareness that there's a lot of mixed signals in the market and a lot of confusion and a lot of very different headlines out there. So they're coming to us and asking that advice and making sure they take the right steps.
Okay. So,
And both bootstrap, for sure.
Really?
We do see much more bootstrap businesses, but let's be honest here, we are working with mainly female-led businesses. They always have more traction, more bootstrap, much more validation out there. It's just the case. Yay!
I want to, Eric, maybe a slightly more difficult question coming your way. So we talked about these companies that have raised at kind of, semi-ridiculous valuations in the past. Maybe not ridiculous, but they're going to struggle to justify them. I'd love to hear your thoughts on the investor mindset around down rounds, flat rounds, and how you think about those. And in particular, your fund is limited in size, so you can raise another fund, so on, so on. Have you had to make any, or are you anticipating having to make any difficult decisions where you say, okay, we can support this company through a down round, portfolio company, or effectively, they're on their own and we're going to use the remaining capital to make new investments?
I think we learned a lot. We've been live since 18, and in the beginning, and we obviously are in love with all our portfolio companies.
Yep.
And especially when Corona hit, it was a tough time, and there was really we needed to bridge a lot. I think we are a little bit more hard now,
Yep.
and saying, hey, and I think it comes back to my point about product market fit.
Yep.
I think it's actually when we are looking at founders, like let's not give them another opportunity to play if they have not been able to prove that they can find this product market fit.
Yeah.
It is fair enough. You did a try. It's okay.
Had your shot.
Like the essence of pre-seed is it's a prototype. It's a test. Let's see if it's validate, and if it's not a failure to say that was the money spent. Let's not it's okay to do that. So that's the type in that early stage. When you're looking at a later stage, this market is brutal. You don't want to go out and raise money right now if you're raising for a Series B or Series C.
Yep.
The terms are toxic to an extent I have not seen since 2008 or
Specifically a growth, is that?
We are looking at 50% valuation. We are looking at preference, like 2-3 times liquidation preferences.
Wow.
We are looking at basically pay to play, that if we as existing investors don't come in with something, we'll be wiped off the cap table. It is like really just like what do you call it, the wall up in whatever. It's really difficult. So that's why we are very much encouraged for the later stage companies. Be real. That is the number one thing. Whatever you have been thinking on your budgets and saying, hey, we will reach these numbers next year, go back again, reassess, because the worst you can do is set yourself up for failure by saying, we will hit these type of numbers and we will break even by end of the year, and it actually happens that you're not hitting these numbers and you're not breaking even, and you need to come up to surface for air, and you've not met the numbers, you're going out to market and you're going to be shot dead on arrival.
Yep.
So this is like where you need to be careful.
Be realistic.
Yes.
Yeah. Which can be hard when you're selling a dream.
Yeah. Yes.
On the term side of things, Monik, are you seeing founders at the pre-seed seed stage? Are they being more realistic about like valuations, terms?
No.
Really? Is that the same with everybody?
I think why I'm saying that, because Baron, we do invest slightly later than you as well, but they still, if the founder's very aware of what's happening in the wider market, they'll know. And if you know you need this funding, if this is your only option, I'm not saying it's a shitty founder and they only can get money from one place. I'm just saying you need to be realistic about your valuation as well. I mean, some founders can also have a bit of an ego thing, and or they'll say, well, actually, this company in the US got funded for 5 times more, and that's the valuation we're demanding. We've done, for example, on the point of down rounds, we've done one of our first few investments, we've done a down round, 20% down round, but they needed the funding, but they gave such a solid and robust plan of what they're going to do with this funding. It's not a case of, we're still going to do the same thing. We're not growing quite as fast as you want us to be, but give us a bit more money and we might do well in 6 to 12 months' time. You absolutely won't get funding for something like that, So I think really, and we've done an investment where we've done a flat round from their pre-seed to seed, because their pre-seed was way overvalued.
Yeah.
And that was a great round we did with Sequoia and so on. So it wasn't a case. Again, it's not a negative thing. If you have a solid plan as to how you're going to get to the next phase, you will always find your investors or other investors backing you in that point.
I think it really depends on the industry as well. If you look at the consumer businesses, for example, everybody knows that the consumer valuations have massively dropped, right? So I've had founders hoping to raise with a 4x, but then obviously dropping that to 3x or 2x, because they understand that it's very hard to get a consumer business funded. And we're talking about consumer products, right? And it really depends on the industry. And I think what's very important is oftentimes we give founders the advice that you should look at market benchmarks in your industry and go and see what the valuations were. But I think we need to be very careful of giving that advice today, because 2 years ago these valuations were very different in these particular industries, and today they've changed. And I think we work with founders. I think founders come to us more what do you think? What are you seeing on the market? What's the market benchmark right now? And I think there is that reality check, and founders are starting to adjust with this. But obviously, it depends on what stage you're at, and if you had raised at a very high valuation before, it's very hard to come down from there.
I mean, also, just be controversial. I think some investors do take advantage of this whole downturn, trying to be cheeky and get really good deals.
What, in terms of terms, valuation?
Yeah, in terms of terms. I mean, even if they'll be like, just take advantage of a situation where they know this company is great and it is worth what the founders want, they'll be like, well, actually, the market's here and we want to bet, which is not a bad thing, I guess. We're here trying to make money. I know we don't have much time, but I think these questions are hilarious, Joe.
Yeah, there's a lot of Joe-related questions.
Yeah. Joe, you seem to be a bit of a celebrity.
There, I think.
Yeah, I think you should answer some of these. They're really funny.
I'll pick another one first and direct this at yourself, Eric. Anonymous has asked, how do you, as VCs, support morale in portfolio companies if they aren't able to...
Oh, we want a juicy one, Joe. Give us a juicy one.
And so on, so on.
Give us a juicy one.
I think every VC asks about or claims value add. Like, what does value add look like now?
I don't think it's really changed of the value add that we are providing. But I think it's, given the background we all come from a founder perspective, I think it's really just, for founders, the biggest challenge they have is what is they should focus today. There are so many things when they get up every morning, there's so many things that they need to solve. The number one thing we can help them with is keep that focus, help them on setting those priorities and support them in that and being a second opinion. We will never take a decision. We will only offer advice. We don't say it's the great advice or anything. We're just saying this is our second opinion. And you can take it or leave it. It is you as a founder that is sitting in the driver's seat. We will always be a minority investor. And it's like, we back you because we believe in you. And whatever we do is just try to get you a little bit to think about what you're doing.
I think another positive as well, given we always talk about negatives, is, for example, when we invest, we have something called the founder pledge. So we'll give 1% additional, whatever we invest, like non-dilutive, just cash to the company for anything that is for the founder's well-being and development. So again, not to, there's, I think the positive aspect of it is investors are also becoming more aware of the founder's well-being and their mental health. We force them to take holidays. We will support them if they want to get counseling or exec coaching or therapy, which is all okay. And the positive is we are talking about this more openly as a market, as an industry, well, I guess in general. So that's, I mean, there's, in addition to all the value add that everyone talks about, but I think don't look at metrics, don't look at bringing in expertise. Sometimes just ask the founder, how are they doing? And see if there's anything you can help them with.
And to that point, actually, I think a lot of founders think that they can't share enough with investors. I think every VC out there actually wants them to be seen as almost like partners rather than them to be the last ones to hear about the bad news. I think founders should start treating their VCs and their investors really as partners and really as a sounding board and go to them when they need the help. Because we all know that markets are tough and we want to help our portfolios to succeed. So now I think we should be more open and collaborative on that sense.
So I think we have 10 seconds left. Very final quick question for all of you. Snapshot. I mean, I already know Eric's answer. This is the new norm. We're not in a downturn. This is reality now. Are you two both in the same position, or do you think the frothy times will come back?
They will always come back. I mean, I built my first company in 2009, which was the last recession. We're here again, right? But I think great opportunities are brought out of the challenging times. So I'm actually excited what is happening after this downturn. And we just become more resilient. We become more decisive. We become more empathic. I think this is a skill set that every founder needs, and it teaches us to become better founders.
Monik?
Yeah, what Triin said.
What Triin said.
Yeah.
Cool. Well, thank you so much, guys.
Thank you.
Thank you, everybody.
Thanks, Joe.